Well, here we are, the final quarter of 2025. If your social feed looks anything like mine, it's probably swinging wildly between "it's over" and "we're so back." But here's the thing. Amidst all that noise, a major new report has landed that cuts through the chaos. It's packed with real data, not hopium, and it paints one of the clearest pictures yet of where crypto could be headed next. Today, we're diving deep into Coinbase Institutional's Q4 2025 Outlook, created in collaboration with the on-chain analytics powerhouse Glassnode. It's called Charting Crypto, Navigating Uncertainty, and it's not just a market report. It's a roadmap for how investors, big and small, are thinking about the next 3 to 6 months. Now, quick reminder, I'm not a financial advisor. Nothing here is financial advice. This is purely educational content designed to help you understand the crypto landscape better. If that sounds good, hit that like button and let's get into it. The report starts with a survey of over 120 investors, a mix of institutions and independent traders, gathered between September 17th and October 3rd. The results? Surprisingly optimistic. Roughly 2/3 of respondents expect Bitcoin to reach above $130,000 in the coming 2 quarters. But here's where it gets interesting. Almost half of institutional investors believe we're already in a late-stage bull market, while only about a quarter of retail investors agree. In short, the pros think we're deeper into the cycle than the crowd realizes. And that usually means they've already taken some risk off the table. When asked what their biggest concern was, macro factors topped the list. Inflation, unemployment, and central bank policy shifts remain the #1 tail risk. Everyone's optimistic, but not blind. The message is clear. Sentiment may be bullish, but the fear of a macro shock still looms large. ETFs were another big topic in the survey. Most respondents agree that spot Bitcoin and Ethereum ETFs have become structural, not speculative catalysts. They're still bullish for prices, but they're now viewed as part of the foundation, not fireworks. ETFs have matured into baseline infrastructure that brings steady liquidity and institutional credibility to crypto markets. Interestingly, respondents also mentioned crowded trades, over-owned assets where too many investors are already piled in. Solana and digital asset treasuries, or DATs, were named as top examples. That doesn't make them bad trades. In fact, good trades often become crowded. But it does mean that entry timing and risk management are more critical than ever. Now let's talk about what Coinbase believes will shape the rest of the year. The 3 big trends that could define Q4 2025. Digital asset treasuries, DATs, real-world assets, RWAs, and the rise of prediction markets. First, digital asset treasuries. These are public companies, asset managers, and funds accumulating crypto as part of their treasury or product strategy. BTC-focused DATs now hold around 3.5% of all Bitcoin, ETH DATs about 3.2%, and Solana-focused ones more than 2%. These figures are still climbing. In total, more than 40 DATs now collectively hold nearly 800,000 BTC, most sitting above their cost basis, meaning they're in profit. Even though DAT stock premiums have softened slightly, Coinbase expects this accumulation to continue into the 4th quarter. Next, real-world assets, or RWAs. This is one of the most explosive growth areas in crypto. The total RWA market recently hit $30 billion, fueled mainly by tokenized private credit and U.S. Treasuries. In short, traditional finance is moving on-chain, fast. The result? Builders and investors now have access to tokenized, yield-bearing dollars that create more predictable cash flows and bridge the gap between DeFi and TradFi. Finally, prediction markets. Long considered a niche, they're now breaking into the mainstream. Platforms like Polymarket have seen record-high trading volumes this year, with activity surging around real-world events. Coinbase argues these markets are demonstrating genuine product-market fit, combining curiosity, speculation, and participation in a way that could make them crypto's next major breakout use case, right up there with stablecoins. The report also looks backward to explain where we are now. It notes that global M2 money supply, a leading indicator for BTC price movements, expanded during Q3, giving crypto a friendly tailwind heading into Q4. But there's a catch. Coinbase expects a potential tightening in November, which could briefly cool momentum. When analyzing Q3 performance, smart contract platforms led the charge. Ethereum up 70%, Avalanche up 64%, and Chainlink up 61%. Bitcoin, meanwhile, delivered smaller single-digit gains as investors sought higher beta plays. But the uneven performance across the top 50 coins showed one clear theme. This isn't an index buying market anymore, it's a narrative-driven one. Bitcoin dominance dropped from 64% to 57% by mid-September before rebounding. That's evidence of a cautious rotation into majors like ETH and SOL, but not a full-blown alt season. Futures and options data also show a market that's active, but not overheated. There's leverage in the system, but it's balanced. On the ETF front, the numbers are striking. Spot BTC and ETH ETFs remained net positive throughout Q3, showing consistent demand. This steady accumulation by regulated funds is quietly reducing volatility and strengthening the market's structural foundation. Combine that with record stablecoin usage, over $300 billion in supply and $6 trillion in monthly transaction volume. And you get a crypto ecosystem that's more liquid, mature, and functional than ever before. Now let's zoom into the two titans, Bitcoin and Ethereum. Starting with BTC, long-term holders barely flinched in Q3. Coins held for over a year only declined by 2%, while short-term supply rose slightly to meet demand. Translation? The strong hands are still strong. Coinbase also highlights that Bitcoin's average cost basis remains below euphoric levels, a sign we haven't hit the kind of overextension typical of cycle tops. Futures open interest for Bitcoin rose 22% quarter-on-quarter, and options open interest jumped 37%, but daily volume dropped slightly. That means more investors are hedging and structuring positions instead of simply chasing price, a hallmark of a maturing market. As for Ethereum, the story is one of surging demand and renewed optimism. For the first time ever, spot ETH ETFs saw more inflows than BTC ETFs, $9.4 billion versus $8 billion in Q3. That's huge. ETF's liquid supply jumped by 18% as some long-term holders took profits, but the overall staking rate continued to climb, tightening supply and reducing sell pressure. Layer 2 ecosystems like Arbitrum, Base, and Optimism kept expanding with record-high transactions and low fees. Meanwhile, Ethereum's DeFi total value locked, TVL, grew in dollar terms but fell slightly in ETH terms, suggesting rising token prices rather than explosive new activity. Still, Ethereum remains the most active and structurally sound smart contract platform in the market today. So, what does all of this tell us? The crypto market entering Q4 2025 is bullish but balanced. There's optimism without mania, growth without froth, and infrastructure quietly strengthening beneath the surface. Institutions are in, retail is cautious, and the macro backdrop, while uncertain, remains supportive for now. Coinbase stopped short of calling this a runaway bull market, but the message is clear. The foundations for long-term growth are stronger than they've ever been. The key for investors is staying patient, data-driven, and selective. This quarter isn't about chasing every pump. It's about understanding where the real flows are going into treasuries, real-world assets, and structured on-chain products. The noise will come and go, but the smart money is already positioning for what comes next. So, as we head into the final stretch of the year, remember, crypto isn't dead, and it isn't euphoric. It's evolving. The players have changed, the rules have matured, and the opportunities are bigger than ever for those who know where to look.